Markets continue to be driven by artificial intelligence stocks and the timing of the Fed's first rate cut. As the dust settles on the inflationary episode of the past few years, what should investors do to maintain perspective in their portfolios? Inflation is improving, albeit at a slower pace. The latest Consumer Price Index report, for instance, showed that prices rose 3.2% on a year-over-year basis in February. This represents a slight uptick from the prior month due to an increase in energy prices. These data points are consistent with consumer price inflation that is heading back toward 2%, although it will take some time. In any case, these figures represent the best-case scenario that investors could have hoped for less than 2 years ago. The money supply has stabilized. Perhaps most relevant for investors today is that disinflation then made way for the Great Moderation, beginning in the mid-1980s. During this time, business cycles grew longer, inflation was subdued, unemployment fell, and markets performed well. While this is only one historical example, it does suggest that falling inflation and a return to more normal monetary policy will likely be positive for the economy and markets. The accompanying chart shows that the money supply has shrunk relative to its post-pandemic peak. This reflects monetary tightening by the Fed, including the shrinking of the Fed's balance sheet at a pace of around $1.1 trillion per year. Markets expect the first rate cut to occur in the summer. Daily market swings continue to be driven by changing expectations for the economy and Fed rate cuts. Recent volatility has been the result of the market shifting to a first cut occurring in June or July rather than in March. For long-term investors, whether this takes place today or a few months out should be immaterial given the broader historical context. What matters is the underlying trend of improving inflation and steady economic growth. A return to more normal monetary policy should also help interest rates to stabilize, resulting in a more attractive financial market environment. The bottom line? Investors should continue to focus on broad economic trends and historical perspectives rather than on day-to-day market swings in specific stocks. For more information, please visit MRAadvisory.com.